If you're in the tech or design world, you know Figma. I mean, it's pretty much everywhere. We all know the product is incredible, but that got me thinking, is the business just as good? We're about to find out because we're going on a deep dive into their latest financials to see if the reality matches the hype.
So, this is the big question, right? We're going to put on our detective hats and really dig into the evidence from their official filings. Let's see if we can figure this out. Does the business model, do the numbers, actually live up to the legendary status of the product? All right, first things first, let's set the stage. To really get what their financials mean, you have to understand what Figma is actually selling. And trust me, it's way more than just that design tool we all started using years ago.
Their mission is huge. I mean, they started with Figma Design back in 2015, but they have not stopped building. Now you've got FigJam for brainstorming, Dev Mode for handoffs to engineers, and of course, in 2025, they're going all in on AI. What they're building is a single, unified platform. It's a whole ecosystem that makes it really, really hard for teams to even think about leaving. That's the secret sauce.
Okay, now for our first piece of hard evidence in this investigation, the revenue numbers. And let me tell you, there is no other word for them but explosive. Just look at this chart. In a single quarter, Q2 of 2025, they brought in almost $250 million. That is a 41% jump from the exact same time last year. You just don't see that kind of growth in a company this big. It's a massive, flashing green light.
Now, if you remember one number from this whole explainer, please make it this one, 129%. For a subscription company like Figma, this number is, well, it's everything. It's called the net dollar retention rate.
So what does that actually mean? It's pretty simple. Imagine a group of customers paid Figma $100 last year. Well, that exact same group of customers is now paying them $129 this year. They're not just staying, they're spending more money. For context, in the software world, anything over 120% is considered totally elite. This proves the product isn't just sticky, it's becoming more and more valuable to its users over time.
And check this out. This growth isn't just coming from small startups. They are absolutely crushing it with big companies. The number of customers paying them more than $100,000 a year, it leaped from under 800 to over 1,100 in a single year. This is that classic land and expand strategy. And boy, is it working for them.
So up to this point, the story is incredible, right? Insane growth, super happy customers. But then you get to the profit and loss statement. And this is where things get a little weird. This is the plot twist in our little financial detective story.
Okay, look at this. On the left, Q2 2024, a net loss of over $800 million. I mean, that's a gigantic, terrifying number. But then you look to the right, just 1 year later, and they've swung all the way to a net income of $28 million. It's just a mind-boggling turnaround.
So you have to ask, right, what on earth happened here? How does a company swing its fortunes by almost $1 billion in just 12 months? Was it about to go under last year and we just didn't know it?
And here's the answer to our puzzle. It turns out that massive loss from 2024 had almost nothing to do with the day-to-day business. It was a giant one-time accounting charge. See, when the Adobe deal fell apart, Figma had to account for over $800 million in stock compensation all at once. So that scary number? It was an anomaly, a ghost in the machine, not a sign that the business was failing.
Okay, great. Now that we've solved that mystery, we can ignore that crazy one-off event and look at the real financial health of the company. So let's turn our attention to the balance sheet and see what clues we can find there.
So the balance sheet gives us a snapshot in time of what Figma owns versus what it owes. Now I know this looks like a wall of numbers, but don't worry. We're just going to pull out two really simple ratios that tell us a whole lot about the company's stability.
The first number we can calculate from this data is 3.3. This is what's known as the company's current ratio.
And this number is fantastic. It means that for every $1 in bills that Figma has to pay off soon, it has $3.30 in cash, or stuff that can be turned into cash really quickly. So could they cover their debts? Oh yeah, they could cover them 3 times over. This is a super healthy sign.
All right, the second key number we're going to pull from that balance sheet is 0.43. This is their debt-to-equity ratio. This one basically tells us how much the company is relying on borrowed money to run its business. And a number below 1 is good, so 0.43 is just stellar.
It means Figma is running on its own money and investor capital, not a mountain of debt. That gives them a really strong foundation and a ton of flexibility for the future.
So, the evidence we've gathered so far points to an incredibly strong, healthy business. But no investigation is complete without looking at the other side of the coin. Every company has risks, and Figma has been pretty upfront about theirs.
So here are a few things to keep in mind. They're totally reliant on Amazon Web Services to run their platform. The CEO, Dylan Field, controls over 73% of the voting power. That's a huge governance risk for investors because it means one person effectively has the final say. They're also flat out telling us that their investments in AI are going to be expensive and will probably hurt their profit margins for a while. These are definitely not things you can just ignore.
So, after all that, what's the final verdict? Is Figma's business as strong as its product? The answer is a resounding yes. The core business is phenomenal. The growth is off the charts, customers love them, and the balance sheet is rock solid. However, those risks are real. The coming costs of the AI arms race are a big unknown, and that governance structure is a major question mark. So for now, our final recommendation is a hold. It's an amazing business for sure, but those challenges on the horizon are significant enough to warrant a wait-and-see approach.